Good morning, everyone. Thank you very much for being here. Thank you, Mark, for the introduction. I'm Neil Dougherty. I'm the Senior Vice President and Chief Financial Officer here at Keysight. I've been with the company since 1996, and I've been in this role as the CFO of Keysight for a little over 4 years, having moved into the position about a year prior to the spin as I was working with Ron and a few others on preparing Keysight for its independence. Immediately prior to that, I was the treasurer at Agilent Technologies, and early in my career, I've spent significant time in the corporate development function, working on mergers and acquisition transactions, and in various controllership positions in the operating businesses of both Hewlett-Packard and Agilent. Today, there's really 5 key themes that I'm going to touch on and come back to over the course of my presentation. First is we've really targeted our investments since our spin on a few key growth areas, and our success in those growth areas now has us gaining momentum in the marketplace. We've made a number of different financial commitments over our first 3 years as an independent company, and we take those financial commitments very seriously, and we're doing a good job delivering on those. And then, as Ron has mentioned, really since our spinoff, Keysight has been a company that's been in transformation. And that transformation is now winding down. And with the transformation coming to an end, we are in a position to improve our financial performance going forward. So we're driving initiatives to improve our operating margins. We're increasing our focus on free cash flow conversion, and we'll be transitioning to a more balanced capital allocation strategy. What I'd like to do next is take a look at the financial performance of the business over our first 3 years as an independent company. And I think what you'll see as you look at these numbers is even as we've been investing heavily in our transformation, we've delivered really solid financial results. Our revenues are up, driven not just by the acquisitions that we've completed, but also by the fact that we've taken a business that historically had been flat and once again turned it into a business that is now growing organically. Our operating margins over this 3-year period of time have been at or above the targeted operating model that we outlined at our Investor Day in September 2015. As a reminder, that operating model was centered around operating margins in the 18 to 19% range. And as you can see, in each of the last 3 years, we've been at or above that level. Over this period of time, we've generated $850 million of free cash flow, and our earnings per share has been stable. But most importantly, as we look forward, we are now in a position to accelerate our performance on all 4 of these financial metrics. I've mentioned that we've made a number of different financial commitments over the last few years, most notably taking a business that had been flat and turning it back into a growing business. The specific commitment we made was to return this business, or get this business to the point where it could grow at a 4% sustained basis, and to do so by the end of 2019. Here we are, it's our fiscal 18, and we will deliver growth this year that is significantly higher than that 4% rate. We announced last week that we expect our FY18 core growth, excluding acquisitions and currency, to be in the 5 to 7% range. We've made a number of acquisitions in our time as Keysight, most notably the acquisitions of Anite and Ixia. And as part of those acquisitions, we made significant synergy commitments. And those synergy commitments are either complete in the case of Anite or well on track in the case of Ixia, only 10 months after the close of the transaction. And then perhaps most importantly, we committed to turning Keysight into a company that was positioned to grow its EPS. And we are on track to deliver EPS growth in FY18 that is above the high end of the range we previously communicated. The next thing I want to do is take a quick look at our balance sheet. Obviously, for me as a CFO, it's important that we maintain the financial flexibility to support the strategic decisions we're making in the business. The numbers on this page are as of the end of our fiscal first quarter, which ended in January 31st, and those results were announced just last week. As you can see, we finished the quarter with about $2 billion worth of debt. Our leverage is still elevated at approximately 3 times following the acquisition of Ixia, but we've made a very public commitment to return our leverage to approximately 2 times, and to do that within 24 months of the close of the acquisition. So that's April of 2019. As we do place a high degree of value on our investment-grade credit ratings. But most notably, with approximately $1 billion of cash on the balance sheet, the $450 million credit revolver, we have ample flexibility as a business as we work to strengthen those investment-grade credentials. Ron spent a fair amount of time this morning talking about our Keysight Leadership Model and how we use the tools within that model to run our business. I wanted to talk about that model further, and specifically how we use KLM to manage our cost structure and drive strong financial performance. And when I think about cost structure management, I really think about it in three key areas. First is a focus on the absolute level of spending within the business and how do you do things as efficiently as possible and at lowest cost. Second is on the structural flexibility that's required to be in the model so that your business results are resilient to changing macroeconomic conditions. And then finally, how do you evolve your model over the longer term so it stays relevant and continues to perform as you expect it? Where I wanted to spend my time today was on this middle section, talking about the structural flexibility that exists within Keysight's operating model. Really over the course of the last decade, we've been working to increase that structural flexibility. And what we've done is we've gone and identified the single biggest drivers of spend within our business and then taken proactive action to increase the variability of those spending categories. So let me give you a few examples. First is our supply chain. Today, about 50% of Keysight's supply chain activities are outsourced. As Jay Alexander mentioned, we retain in-house the key differentiating technologies, those things that provide us technical differentiation in our products and in the marketplace. But many of the manufacturing processes are more commoditized and they are easily outsourced to a network of contract manufacturers. As Mark Wallace mentioned, today about 75% of our sales flow through our direct channel. And we have a highly peaked, highly technical direct channel, but they're largely focused on our biggest, most strategic clients. We sell to over 30,000 customers annually, and so we needed an efficient way to reach out to that long tail of customers without adding all of the fixed costs that would be necessary to do so if we chose to do it directly. And so today, we service that long tail through a network of channel partners and distributors that provides great reach without the associated fixed costs. And then finally, in a model which is a bit unique, 100% of Keysight's employees have a portion of their pay that fluctuates with Keysight's business performance. This does three things for us. First of all, for our employees, it gives them improved job security. And for us, it gives us improved talent retention. But more importantly, it gives us a natural regulator on the single biggest component of our cost structure. And what these things do in concert is they allow Keysight to be highly resilient to changing macroeconomic conditions. And I'm going to quantify that for you in just a few minutes. Ultimately, the way we manage our cost structure and the high leverage that we get when the business is growing organically enables the business to deliver a 40% operating margin incremental when our core growth is at or above 4%. So that's how we use the KLM tools to manage the business on an ongoing basis. But today, we're turning those same tools towards driving an absolute improvement in our level of profitability. So as Ron has already shared, we're working to drive a 400 basis point improvement in operating margin. 2.5 years ago, at our last Analyst Day, we presented an operating model that was based on gross margins in the mid to high 50s, R&D investment of approximately 13%. Now that was prior to the acquisitions of Anine and Ixia, two acquisitions which have pulled up the average investment in R&D, and operating margins of approximately 18 to 19%. As we look forward, with the business now growing organically, we see opportunities to get further leverage in gross margin and G&A, and ultimately drive a 400 basis point improvement in our operating margins. And we expect to achieve that level of profitability by 2021. The single biggest driver is the return to growth. But in addition, we're seeing a favorable mix shift within our business as our solutions have a higher software content than ever before. And increasingly, we're selling our solutions into our customers' R&D labs rather than their manufacturing lines. And we find that that R&D sale is not only less lumpy, but it has a higher gross margin. And we're using the KLM tools I've already described to drive synergies within Ixia and ongoing cost reductions efforts in our core business. Those things in conjunction will drive this profit improvement. Not only will profit increase, but it will be resilient to changing macroeconomic conditions, as I've already talked about. And we continue to think about the right relevant range in terms of Keysight's exposure to changing macroeconomic conditions is approximately plus or minus 10% on the revenue line. So if we were to see a macroeconomic downturn that drove a 10% reduction in Keysight's revenue, you could expect a 3 to 4 percentage point reduction in our operating margins. On the flip side, if you saw a macroeconomic expansion that drove an increase in Keysight's revenues of approximately 10%, you'd expect to see an additional 2 to 3 points of profitability. So not only will we be working to improve the profitability of the business, and not only do we expect our cash flow generation to mirror that profit improvement, we actually expect to do better on the cash flow line. If you look over the course of the past 3 years, we've converted approximately 65% of our net profit into free cash flow. And that's because we've been investing heavily in our transformation. Those transformational investments are coming to an end. We'll wrap up the acquisition or the integration of Ixia in Q3 of FY18. And with those investments coming to an end, we're in a position to convert profitability to cash flow at a much greater level. So as we look forward to FY19, we expect that we'll begin to convert cash flow at approximately 80 to 90% rate. Not only will the business be generating higher profitability and higher cash flow, with the passage of tax reform, we will have better ability to access that cash. So I wanted to spend a few minutes and talk about the 4 ways that the tax reform legislation that passed in December will benefit Keysight. First of all, it does provide a reduction in our tax rate of approximately 200 basis points, from 17% under the old structure to approximately 15% in the new structure. But more importantly, it dramatically increases our ability to access the cash that we generate. Under the old system, at our tax rate of 17%, we had access to 25% of our global free cash flow in the US. Going forward, even as our rate drops by 200 basis points, our ability to access cash increases dramatically, and we expect that going forward, we'll be able to access 90% of our global cash generation. As you are all aware, the tax legislation included a provision to allow a one-time repatriation of existing offshore cash balances and historic foreign earnings. That provision will enable Keysight to have access on a one-time basis to access over $500 million of our existing offshore cash balance with an associated tax cost of $95 million approximately, which is payable over the next 8 years. Ultimately, what tax reform does for us, however, is it allows our capital allocation strategy to more holistically take into account our global cash balance and the global cash generating capabilities of our business. I feel like Marco Rubio. So now that we've taken a look at tax reform, let's take a look at what those capital allocation priorities are. The number one priority remains clear. We will continue to invest in this business to drive profitable organic growth. We believe we're investing in R&D at approximately the right rate, 15%, and you can expect that investment in R&D to continue moving forward. Our investments in capital expenditures are also relatively stable at approximately $100 million per year. We do expect them to be a little bit higher here in FY18 as we work to recover from the Northern California wildfires, which impacted our headquarters site. But those amounts over and above that $100 million run rate should be covered by our insurance policies. And then finally, as Mark mentioned, we're investing to increase our direct sales channel, but we'll do so within the cost envelope that exists and within the operating models which I've outlined for you here today. Our second priority is to delever following the acquisition of Ixia. And as Ron has already mentioned, just last week, we repaid the final $260 million of what was $540 million of prepayable debt that was put in place to fund that Ixia acquisition. We now expect that we'll achieve the 2 times gross leverage ratio by the end of this fiscal year, 6 months ahead of schedule. We do expect that we'll continue with our disciplined approach to M&A, although currently we're heavily focused on absorbing the Ixia acquisition and ensuring that we get a return on that investment. So at least initially, that M&A activity is likely to be more of the tuck-in variety. We continue to view M&A as a tool that will, over the long term, help us achieve our organic growth objectives. And so we're focused on targets that align with those growth priorities. Current areas of focus are software, high-value automotive, and services. Those are all areas where we believe we have potential to find targets. And then finally, return of capital. Our ability to switch to a more balanced return of capital strategy is really driven by the fact that we've returned this business to growth. But it's further enabled by the access to cash that comes from tax reform. And as Rhonda's already announced, our board has just approved a $350 million share repurchase authorization, which we will begin to implement with an initial intent of offsetting the dilutive impact of our equity-based compensation programs. So with those as our capital allocation priorities, I did think it made sense to just spend a couple of additional minutes talking about our approach to M&A. We have a set of strategic criteria and financial criteria that we use when evaluating potential targets. And we take a long-term view of value creation through M&A. And as Jay has already mentioned, we've done 6 transactions during our time as Keysight, 3 small ones in the services space, the acquisition of SignLab in the automotive space, Ixia in the communications networking space, which now allows us to provide our customers with complete end-to-end solutions, and Anite, which plugged a significant hole in our wireless portfolio. These 6 acquisitions align well with our strategic criteria as they're helping us achieve our organic growth objectives, and they have significantly helped us improve our position in the marketplace. Today, we hold a leading position in a $15.5 billion market that is growing 3 to 5%. We segment that market into 6 different segments, and we hold a number 1 position in 5 of those 6 segments, with the 6th one being network visibility that came to us as part of the Ixia acquisition. A key driver here is that we don't have any single one driver that drives growth in our business. We have a diversity of end markets that provides strong balance. And with our focused investment in various subsegments in these markets that are growing more quickly, we believe that we will continue to take share. And today we are raising the growth expectations for this business to 4 to 5% on average over the cycle. Like many of you, I suspect many of you aren't electrical engineers, and neither am I. So I realize that Keysight can be a business that's difficult to understand if you're not used to talking about dBs and gigahertz and such. But as I step back, I do believe that there are aspects of Keysight that represent a really compelling value proposition for our investor base. First of all, we're a market leader in a diverse set of growing end markets that have high barriers to entry. We're once again growing organically and taking share in the marketplace, having taken share in each of the last 3 calendar years. We have a growing base of recurring revenue driven by the growth that we're seeing on our software and services business. We have an extraordinarily deep customer base, touching over 30,000 end customers annually, with no single customer representing more than 3% of our revenues. We're the recognized technology leader in electronic design and test. And it's worth noting that approximately 50% of our revenues come from products that were released in the last 5 years. We have a proven track record of profit generation and cash flow generation, and we're now positioned to raise the bar in our financial performance. So let me remind you what those increased financial objectives look like. We're increasing the targeted core growth rate that excludes foreign currency changes and acquisitions to 4 to 5% over the cycle. We're adding 400 basis points to our targeted operating margins and expect to achieve that level of profitability by 2021. And this will drive EPS growth that is greater than or equal to 10% moving forward. Let me just give you a further idea of what that might look like. In 2017, this business delivered $2.53 of EPS. As we look forward, driven by the growth that's coming in our business, the synergies that we're getting from Ixia, the ongoing cost reduction efforts that are in the business, and managing our share count, we believe that by 2021, we'll deliver EPS that is at or above $4 per share. So in summary, Keysight's delivering solid financial performance, and we're raising the bar. We're meeting or exceeding our financial goals. We're raising our financial commitments, increasing our focus on free cash flow, returning capital, and accelerating our outlook for EPS growth. With that, I'm going to turn it back to Ron for some final comments, and then we'll move to the Q&A.